Hey everyone, welcome back to the channel. Today, we're diving into a crucial topic for anyone involved in startups or venture capital contracts. Whether you're an entrepreneur seeking funding or an investor looking to make informed decisions, understanding these contracts is key to success. Let's break down the essentials. First up, let's talk about anti-dilution provisions. Imagine you've secured an early investment, but in a later round, the company raises funds at a lower valuation. Anti-dilution provisions are there to protect early investors from having their ownership diluted. There are two main types: full ratchet and weighted average. Full ratchet adjusts the conversion price to the new lower price, ensuring early investors maintain their percentage ownership. Weighted average, on the other hand, is a bit more balanced. It takes into account the total number of shares before and after the new issuance, leading to a fairer outcome. Next, let's explore participation rights. These rights give investors the ability to buy shares in future rounds or be the first to purchase shares being sold by other shareholders. It's all about maintaining influence and control as the company grows. Control rights are a big deal in venture capital contracts. Who gets to call the shots? Typically, investors want control, especially when things aren't going well. But entrepreneurs need some control too, especially when the company is thriving. Voting rights and board representation are key here. VCs often have significant voting power and board seats, but it's all about balancing that power to make sure the company stays on the right track. One of the smartest ways to structure funding is through milestone-based funding. Instead of getting all the money at once, the company receives funding in stages, each tied to specific performance goals. This approach not only motivates the team to hit those milestones, but also gives investors a way to manage risk and ensure their money is being used effectively. Now let's talk about exit provisions. These are the terms that determine how and when investors can exit the company. Common clauses include tag-along and drag-along rights. Tag-along ensures minority shareholders get the same deal as majority shareholders if the company is sold. Drag-along gives majority shareholders the power to force a sale, ensuring a unified exit strategy. Finally, let's touch on employee terms and stock restrictions. These are essential for aligning the interests of employees with the company's success. Vesting schedules, for example, ensure that employees stick around long enough to see the company through critical phases. Typically, vesting occurs over 3 to 4 years, creating golden handcuffs. This means employees have a financial incentive to stay with the company, especially during its most challenging periods. Staged capital commitment is another control mechanism. By funding the company in multiple rounds, investors can monitor progress and decide whether to continue investing or not. Staged funding helps mitigate risks for investors while giving entrepreneurs the opportunity to prove their business model before raising more capital. So there you have it, a breakdown of key elements in venture capital contracts. Understanding these terms can make a huge difference in how you negotiate and manage your investments or funding round. If you found this video helpful, make sure to hit the like button and subscribe to the channel for more insights on entrepreneurship and finance. And don't forget to share this video with anyone who might benefit from it.